Hey everyone, this is Ian from ppcian.com. Today I want to explore a hypothetical question. What if I was starting over and I had $1,000 to invest? How would I invest that $1,000? I could invest it anywhere I liked. What would I do if I had $1,000? Well, today that's the topic of the video, and I look forward to exploring this question, dividend growth investing style. So if you've been following my channel for a while, you know that my channel is all about dividends, passive income, and cash flow. I'm the type of investor that invests for dividend checks and cash flow, and one day my goal is to have all of my dividends surpass my living expenses. So if I had $1,000, what I would do is I would invest it in dividend stocks. And I want to go through exactly how I would do that. I wrote down some notes here in my notebook, as I always do. And I have a bunch of things that I would do with this $1,000. So first and foremost, and this may sound a little bit controversial because everyone out there always hears about diversification, but if I personally had $1,000 to invest, I would invest it in one stock. That's right, I would purchase one single stock. I would purchase the best possible dividend growth stock that I could find out there in the marketplace. And the reason that I would do that is to minimize commissions. If I were buying too many stocks, I would be paying commissions each time I bought, and so by buying one stock, I would be minimizing commissions. Moreover, I would be improving performance. It's my belief that the more stocks one buys, sometimes it can dilute performance, and certainly with a greater portfolio, with a bigger portfolio than $1,000, multiple positions are warranted. But in my personal situation, if I were just starting out at $1,000, I would buy one single stock. So next point, what I would do, I would buy this stock in a dividend reinvestment plan. When you're a smaller investor, these dividend reinvestment plans can be really helpful. Well, and for larger investors as well. So not only small investors, but large as well. But when you're just starting out, especially when you're just starting out, those dividend reinvestment plans are wonderful. What is a dividend reinvestment plan? I've got other videos about this on my YouTube channel, so please check them out. I'll link to some of them below in the description. But the quick definition is a dividend reinvestment plan is a plan where you can buy stock directly from a company. A company will appoint what's called a transfer agent to manage all of their stock, and through the transfer agent, you can buy stock directly from the company. Some of them have fees, some of them have high fees, but a lot of them still have really low fees or no fees, which is great for a smaller investor. One thing to keep in mind, if I had $1,000 and I was buying one stock, and I had the choice between two stocks, one that I really, really love, but it had some fees associated with the dividend reinvestment plan, and then one other one that had no fees, but I didn't like it as much, I would always go for the one with the fees, because I don't want fees to get in the way of buying the right investment, investing in the right stock. What I would do next is I would make a lump sum investment. If I were investing just $1,000, I would want my money to start working for me immediately, especially because I'm investing for dividends and cash flow. Sooner I get the money in the market, faster I get my first dividend check. Also, with $1,000, again, just minimizing commissions, it's easier just to invest it as a lump sum all at one time. What else would I do? I would make sure to reinvest all the dividends. So the beauty of a dividend reinvestment plan, just as the name implies, is it allows one to reinvest dividends. And the compound interest that can be accumulated through reinvesting dividends over time is mind-blowing. It's amazing. And so what this means is each time the company pays a dividend, typically quarterly in the United States for dividend-paying companies, take the dividend, reinvest it. And what that means is you can buy fractional shares in the same stock through the dividend reinvestment plan, and then those shares that you buy in turn over time will pay dividends. You take them, you reinvest them. Those reinvested money will pay dividends. You reinvest it. You can see it compounds. It's a snowball effect. This is how dividend reinvestment plan and dividend growth investing works just so well for long-term appreciation and long-term cash flow. What else would I do? This is a little bit unfair based on the question, but I would make periodic investments. getting into the dividend reinvestment plan, getting that initial $1,000 in there. After that, I wouldn't give up. I would make periodic investments over time of $25, $50 at a time, whatever my budget permits. Obviously, the question here is just about $1,000, but that's what I would do. After the $1,000, I would try to make periodic auto investments, dollar cost average in even more. And the reason I'm mentioning this is once someone starts investing with dividend reinvestment plans, they typically love it. They see the results, they see the cash flow, and even if one doesn't think they have the budget right now, once they're in the game, once they've got that $1,000 working for them, oftentimes someone will find a way to come up with that budget. You'll find a way to have that $25, $50, carve it out of one's budget to get it working in the stock market. So I would take advantage of dividend reinvestment plans not only to reinvest the dividends, but to make periodic auto investments over time. What else would I do? I would buy a blue chip stock, a big one that's been around forever, one that will be around forever. This inherently creates diversification. We talked about diversification earlier, and you might be thinking, Ian, you're crazy, you'd just buy one stock. Well, the fact of the matter is you buy a big stock that's in the hundreds of billions market cap, or at least over 50 billion, that company has a diversified portfolio of products and services and revenue, and it's almost like buying a mutual fund. Sure, it might be in one specific industry, but there's diversification. Very few of those mega cap companies are making all of their revenue, all of their net income on one particular product. And obviously in my research, I'd make sure that I bought one that was diversified. What else would I do? I would target a stock that has 7% dividend rate of growth of the dividend yield over time. You can go to some websites on the internet, just Google it, look at the historical track record. I don't want a company that raises the dividend 1% a year, 20% the next, 1% the next, 3% the next. I want one that's consistent. 7% increase, 7% increase, 7% increase. Keeps increasing like clockwork over time. The reason for this is one of the secrets behind dividend investing is not just buying a stock that pays a yield. It's buying a stock that pays a reasonable starting yield, but it grows the dividend over time. So each year they reward the shareholders as the business does well. As the business has more income coming in, they take that income, they give it to the shareholders. And there are stocks out there that, like clockwork, raise the dividend around 7% each year, every year. And those are the stocks that I love. Those are the ones I would target for my $1,000. What else would I do? I would choose a dividend stock with a payout ratio around 50%. Payout ratio is the percentage of net income that's going out to shareholders as dividends. If it's too low, like 20%, company's not rewarding shareholders enough. If the payout ratio is really high, like 80%, 90%, 100%, too high, too risky, oftentimes indicative of a yield trap. Some of those stocks might, in fact, have a very nice looking yield, but it's too good to be true. I like 50%. That's sustainable. I would also pick a stock with a 3% yield, thereabouts, starting yield. Similar point to the last one. Yield too low? It's just too low. They're not rewarding shareholders. Or it's a really high growth stock with like a high PE, just not my thing. If the yield is too high, could be indicative of a yield trap, meaning that stock pays a really high yield because they're not doing well and the stock's gone down and the company is just, business model is out of favor and probably not coming back into favor. And so to summarize the strategy that I would take if I were investing $1,000 in dividend growth stocks, I would buy one stock, I would buy it in a dividend reinvestment plan, I would make a lump sum investment, I would reinvest all dividends, I would try to make periodic investments over time. I would buy a blue chip that's been around forever, I would target a stock that has a historical track record of raising the dividend 7% per year each and every year. I would target a payout ratio close to 50% and a current starting yield of around 3%. So what would this mean in terms of numbers? I don't want to spend too much time on it today because this is just kind of an introduction to what I do with my $1,000. But let's just take a very conservative model. And I love conservative modeling because you just don't want to get ahead of yourself on the numbers. You don't want to get ahead of yourself and model too aggressively, set yourself up for failure or disappointment. And quite frankly, with dividend investing, a conservative model works just fine. So I know I said I'm going to reinvest all the dividends, but let's assume for a second that I don't do that. I just take the check each time it comes in. Also, let's assume the stock doesn't go anywhere. I get no gains on capital appreciation. It just stays flat for 30 years. Here's what's great. After 30 years of investing, my yield on cost, meaning the dividend yield, the 3% that I start with after 30 years, it will be 23%. What that means is for my $1,000 investment after 30 years, I'm yielding $230 per year in perpetuity, forever. And that's assuming they don't even grow the yield anymore after 30 years. It just stays flat. 23%. So that is the magic of dividend growth investing. That starting yield is only 3%, but because it grows 7% per year over time for the long term, it turns into 23% yield for the initial $1,000 that I invested. Now, again, that doesn't take into account reinvested dividends, which would snowball the effect even more, and it doesn't take into account capital appreciation, which is another nice to have. That I don't plan to sell stocks. I buy stocks and hold them forever. I plan to buy stocks just for the dividend income. But many investors out there enjoy some capital appreciation, and surely after 30 years, if you buy the right blue chip stock, it will probably have not been flat for 30 years. It will probably appreciate as well. This is Ian Lopuk, ppcian.com. My YouTube channel is about investing in dividends and cash flow, passive income. If you enjoy the video today, I please invite you to like the video, to subscribe, to comment. Those comments, subscriptions, likes, they mean the world to me. It's the greatest way that you can thank me for producing this content on YouTube. Now, before I leave, I do want to add a disclaimer. This is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you are going to go out and invest capital, please do consult a licensed financial advisor first. Thank you so much for watching. I will see you in the next dividend growth investing video.